So, when you take a look at, because that's a risk story, and you've helped educate our listeners for years on the risk story of saying that, well, smaller companies have more risk than larger companies, therefore you're compensated for that risk.
Well, you're compensated for it. It's important, Joe, to add you're compensated for it, as I'm sure you know, but for your listeners to make sure, not with higher returns, but higher expected returns. And that's the same thing about stocks, that people invest in stocks not because they have higher returns, because they have higher expected returns. And you could go a decade, as the S&P did from 2000 to 2009, and lose 1% a year,
Right.
while T-bills were maybe earning 2, so you had a negative equity risk premium of maybe 3% a year. And the same thing is true of small and value stocks. They can underperform for very long times as well, and that must be true because otherwise there'd be no risk and there'd be no risk premium. So you have to be prepared to accept long periods and stay the course.